Welcome to our next live stream. And joining me today is my partner in crime, Jill, and she's going to be assisting me for the duration of the next hour or so. Just a couple of points before we get going here. Of course, the big disclaimer, some of the information that I give you here will be exact, 1 + 1 always equals 2 type of stuff. Some apply to most of you, and some will be an educated guess about the person's specific circumstances and their intent on the question. Because of this, please take the information as educational only before taking any actions on anything we talk about here. Do your own research, and in many circumstances, talk to a qualified professional familiar with your specific circumstances. Now, we're going to begin with a question. So why don't I ask Jill to put it out there for everybody to answer.
All right, welcome everyone. And the question tonight is, what is the maximum age a spouse should file for the spousal benefit? Is it A, at 65, B, full retirement age, or C, at 70? Go ahead and put your answers into the chat box. And of course, as always, do put some questions in so that we can bring those to Geoff live tonight. Not seeing anything coming in yet, but there's always a delayed response. Still waiting. Okay, here they start. They're coming in. Full retirement age, 62. Full retirement age, 65. Full retirement age, or B, C, B, C. A lot of B's coming in. Some see none of the above. Full retirement age, full retirement age. So it looks like most people are saying full retirement age at this point.
And that is correct. It is full retirement age, unlike the primary insurance amount, which the primary insured can wait until age 70 and get a larger payment than 100%. The spouse can only maximize their payment at full retirement age. There is no delay beyond that, which will increase the full retirement age benefit. Of course, the spouse can't file until the primary insured files, but assuming that the primary insured files, the answer is full retirement age. That's the age where you maximize the spousal benefit. Now, before we get going here, gang, I've been talking a lot about a course that I have been working on day and night for the last 6 months called Social Security Simplify. This course is finally ready, and it's something that we put out on Friday. Very popular, seems to be doing quite well. It's a course that is designed to help those that have some questions about Social Security and really can't seem to put it all together themselves. It's there to help them. And you can find the course at holyschmidt.com/social security. And because this is the month that we're launching the course, we're giving everybody 50% off. We're calling it the early adopter discount. And it's a discount for those that purchase the course in the month of August. So if you're interested, go to holyschmidt.com/social security. Doesn't get any easier than that. It's my web address /social security. And I know that Jill had some thoughts on the course as well she wanted to just talk about, because you worked with a lot of the testers on the course. It's 7 or 8 of them, I believe.
Yes, I have. I've been interviewing some of the people that joined in on the beta test for the course, and really exciting feedback that has been coming back. People are really finding that it's providing a lot of clarity and answering a lot of questions. And it's helping them it's empowering them to feel like they are in a really informed position to make good decisions. So far, the feedback's really good.
Great. All right. Why don't we jump into the questions, and I'll start answering them.
Okay, great. And I just want to put out there to everyone, please do put your questions into the chat box. We'd love to have the opportunity to answer them live for you. Many of the questions that will be asked tonight have come from last live, where we did not have an opportunity to finish all of those questions, as well as some new ones that came in through email. So thank you for providing all those questions. All right, the first question comes from Jeremy. If I wait until age 70 and my wife waits until her own full retirement age, will her benefits be based on half of my amount at age 70 or full retirement age?
They will be based on half your amount at full retirement age. And let me explain to you what that means exactly. So you heard me allude to it when we were talking at the beginning of the live stream, and that is that when you as a spouse take out your spousal benefit, you can only maximize up to 50%. That you can only get 50% of the full retirement age benefit. So even if the primary insured waits until age 70, and let's assume that their primary insurance amount maximizes at 124%. Let's say that they reach full retirement age at age 67. That's 2026, by the way, for most of you watching this, 2026 or later. Full retirement age is age 67, but you can wait until age 70 and get 124%. But the spouse doesn't get 50% of 124%. The spouse always gets a maximum of 50% of the full retirement age benefit, so 50%.
Okay, next question is from Johan. I have 9 years of U.S. contributions. Is there any way to qualify for Social Security benefits after age 62 while living abroad, or to meet the 10-year minimum Social Security credits from outside the USA at current age 57?
So, yes, it's complicated, but I'm going to break it down for you. There's something called a totalization agreement. And a totalization agreement allows anyone really who's living outside of the United States, if they're in one of the 30 countries that we have a totalization agreement with, to use the amount of Social Security that they pay outside of the country into that local country's taxing system to qualify in back into the U.S. So if you've got 9 years and you spend 2 years in one of the 30 countries and you're paying taxes into the local Social Security system, those will count. Now, there's a lot to this. There's a lot more to this than what I just said. And to be frank, there are only 145,000 people out of a population of 55 million that actually have utilized this in the last few years. It's a very small number. So my recommendation to you is write down the words totalization agreement and talk to an accountant that is in either in the U.S. or if you're working for a company outside of the U.S., talk to your HR department and ask them to put you in touch with an accountant that knows about totalization agreements and just to make sure that you actually qualify for them. But in theory, yes, you can do it.
Okay, next comes from John. Can you discuss how the spousal benefit is calculated? My understanding is that it is half of my full retirement age benefit. My age is currently 66 and a half. I also understand that is the case even if I wait to start collecting at age 70 and my spouse's age is 67. In other words, her spousal benefit is determined partially by what my full retirement benefit was, as I'm past full retirement age but not yet collecting. Start collecting at my age 70 and her age 67.
Yep. So, yes, the spousal benefit maxes out at the spouse's full retirement age. In fact, this is a point that is confusing for a lot of people, and that is, do you end up in a situation where if you claim early, that the spouse is penalized? And the answer is no. It's always about the spouse's age for the spousal benefit. You do need to go first, so the primary insured does need to go first. But once the primary insured files for his or her primary insurance amount, then the spouse can claim whether the primary insured filed at age 62, age 66, 67, or 70. It's always about the age of the spouse and his or her own full retirement age. So for the spouse to maximize, it's their own full retirement age, not the primary insured's.
Okay, Michael Conger is asking, does per diem count towards the wage limit? The reference is that working while retired, but not at full retirement age.
So this is a question about per diem. So it depends, and I'll tell you just without knowing anything about your company, there's going to be a lot of disclaimers around this. So a per diem is an amount that you receive for spending on things. When you think about it, when you're traveling, if you travel and you buy a lunch for yourself, or you buy a dinner for yourself, the company often gives you an allowance. It's like a per diem. It's called a per diem. And that allowance allows you to fund your life. Now, the use of the per diem, if it ends up as a reportable wage on your pay stub, then that would be part of your earnings. If it doesn't, then it won't. And a lot of it depends on the company that you work for. It depends on how they actually account for it. But I would talk to your HR department and find out if your per diem ends up on your W-2 at the end of the year or not.
Okay, Deepak Nadkarni is asking, what is the 2026 gifting amount? 2025 was $19K.
That doesn't have anything to do with Social Security. Sorry. Well, the gifting amount for what?
Oh, Deepak, if you want to just add in what that is pertaining to, we can maybe come back to that. Okay, good. So Bill is asking, my wife and I are both 60. Her Social Security is small. Should she claim hers at 62 until I claim mine at, say, 65, when she can then transition to spousal benefit?
So this is something that gets asked a lot in so many different ways. So much so that I'm actually going to put a video out on it, because this is a very complicated issue. And that is that the spousal benefit, there's something called dual entitlement. And that is, if you qualify for a spousal benefit and your own primary insurance amount, and you file, the SSA will give you the higher of the two. Well, what happens if, in this case, the primary insured doesn't file until age 65? Well, that means that the spouse, who would get a larger spousal benefit than his or her own primary insurance amount, when they file for their Social Security payment, it's a tiny amount compared to what they would get as the spousal benefit. That starts the clock ticking. And the way that the Social Security payment is calculated is it's a combination of both. So if she files at age 62, and she would have had an excess payment amount at age 62, but the spousal benefit, but you waited, well, that excess payment's going to grow. So in most cases, the payment will be larger, but it won't be quite as large as if she had never filed at all for her own primary insurance amount. That's a long-winded way of saying it depends, but it is in many circumstances when the spouse files for their own primary insurance amount and then switches to the spousal benefit when the big earner finally files, which is a prerequisite, finally files for his or her own primary insurance amount, and the payment goes up. It doesn't go up completely. There's a bit of a haircut, because part of that payment comes from when the spouse filed for their own primary insurance amount earlier, and there was a discount on that because they filed early. I'll put a video out on this probably later this week, so just watch for it here, because it's been asked enough times on the live stream that I think it's probably due. So check me on Thursday on this, if not on Thursday, on Sunday.
All right, Chris. Great. So Chris is asking, my husband is retiring at the end of this December at age 62 and will be taking Social Security. What taxes will be taken out? We are in North Carolina. I am still working full time.
So there is a fairly rigorous calculation on taxes on Social Security, and basically there are different thresholds. The first threshold is what happens if, as a couple, you file for Social Security and you hit a certain dollar amount. Up until that dollar amount, your Social Security amount isn't taxed. Between the base amount and the next level, that difference is taxed at 50%, and anything in excess of the higher amount, it's taxed. Anything in excess of that is taxed at 85%. So it's not actually complicated, and just not to pitch the course, Social Security simplified again, but the actual way to calculate this taxes on Social Security is in the course, but it isn't easy to do or explain, because you have to break it up depending on how much you earn. And since I don't know how much you earn, then it's going to be difficult to tell you what the taxation will be. But know that at a certain amount, it starts to go up, and eventually it can be up to 85% of your Social Security payment can be taxed.
Okay, great. Annie asks, if I have a lot of passive rental income, is it best to file for Social Security at 62 and invest the money?
I always hate this question. So here's the issue when you talk about taking your Social Security early and investing the money. Normally, the argument is I'm going to retire, I'm going to take Social Security early, and I'm going to invest the money. And then the follow-on question is, well, how are you going to live? And the answer is, I'm going to take money out of my 401k or my IRA. So you're actually funding your lifestyle with investments and taking Social Security and investing. So you're basically robbing Peter to pay Paul, so to speak. There are some circumstances where it might make sense, and really this is a might, and you got to do a lot of work here. It might make sense if you have a pension and you're going to get paid the pension regardless, so you don't actually need to sell investments to fund your investments. It might make sense if you have passive rental income, but understand that there is risk in investing. That and there's always you've heard the term risk and reward. Most investments always have some form of risk, even if it's a small risk. About the least risky investment is the U.S. government. Now, people would argue and say, well, maybe that was then, this is now, but the U.S. government, if you're living in the U.S., is the least risky asset you can own. U.S. government bonds, notes, T-bills, that sort of thing. And so when you start investing early and foregoing certain increases in your Social Security payment, well, those increases are scheduled, and they are predictable because it's in a schedule. So it's a long-winded way of saying it's not a no, but you got to understand the risk-reward ratio to what it is you're asking, and if you're shooting for the moon in terms of your returns from the investments, well, it's pretty risky. If you're putting it all in the stock market and the market goes down for 4 or 5 years, we have a big market crash like we did in 2008, which didn't really recover to 2013. That would be a really bad time or frankly, after the end of that cycle, that would be a really bad time to start investing, because you would have, or 2 years before anyway, you would have lost a ton of money in the 2008 crash, and you wouldn't have returned until 2013. So I know I'm babbling, and I'm babbling because I don't know your specific investments that you're talking about. So the only answer I can give you is it's not a no. And I think that's probably probably the best way to answer this question. Maybe we should leave it at that.
Okay. Della Sinchon is asking, is Social Security going to be privatized? In 2034, will Social Security be reduced by 20% to recipients?
So those are two very good questions, actually. So the answer to the privatization question is they'd have to change the Social Securities Act of 1933 to do that. And the reason, the Social Securities Act of 1935 to do that. And the reason is because in the act, it specifies that any excess money in the Social Security Trust needs to be invested in U.S. government securities. And so the definition of privatization means that you have somebody who comes in and they say, wow, we've got $2.7 trillion here, which is about the amount that's in the trust at the moment. And we are going to take this and we're going to put it into the equity market. We're going to put it into an S&P 500 index. And it can go up and go down, but you have a private manager who's making bets, effectively bets with that pool of money. Well, the U.S. government, in its wisdom, when the Social Securities Act was put in place, didn't want that, especially coming off the Great Depression, where the roaring 20s, people lost everything. And so when the Social Securities Act was put in place, there was a very specific provision that said you can't invest in anything except for the government, U.S. government. And so I think it's highly, highly unlikely that anybody would ever risk changing that because there's such a negative connotation. There are a lot of networks out there that suggest that anything's possible and this is the direction of the government, but there's nothing that actually indicates that. As far as what happens in 2033, 2034, I'm going to take you back in time to 1983 and also tell you, if those of you that have a piece of paper in front of you, write down the numbers 31. In 1983, the Social Security Trust was within 2 months of running out of money. And there was a provision that was put in place. The Social Security Act that I was talking about was put in place, and it was amended. And what happened at the time is that the amount that people were paying into Social Security went from 5.4% to 6.2%, and the company match did the same thing. They had immediately solved the deficit problem. And then full retirement age was raised from 65 to 67, 20 years in the future. So nobody was turning 65 or 66 at the time was going to be facing a situation where they were planning on retiring next year and it didn't happen. And so those that were worried in 1983 that their payment was going to be reduced because it was the same exact discussion, found out that the politicians did step up. Now, the reason I told you to write the numbers 31 down is because the number of major amendments to the Social Securities Act were 31. And that 1983 amendment was one of them. There was one in 10 years later. And I suspect there will be another one in or around 2033. I would love to tell you that the politicians are going to get to it early. I don't think so, because as important as it is to everybody on this call, on this live stream, they don't actually feel the same pain that you do. And I don't mean that in a negative way, but a lot of what happens, a lot of these big announcements about COLA and about the increase in full retirement age, and there are about a dozen other announcements, the announcements that come out, those are on autopilot. And those are on autopilot using something called automatic determinations. I can tell you exactly what's going to be happening in October because they've been pre-scheduled, and it's really going to be based on what's happening with the consumer price index and what's happening with wage indexes. And those are public numbers, are easy to find, easy to calculate. You just plug them in, and then all the variations change. And so all of the big announcements that happen in October, people think the government's actually doing that, the politicians are actually doing that, but they aren't even looking up. It's just happening automatically. So long-winded answer is I would say that there will probably very, very likely be a change to the Social Securities Act. It will fix this, and it will probably come in the form of something like a tweak in the size of the contribution that people are making to Social Security and the company match.
Okay, so Deepak has come back with a new question, which says, I received spousal death benefits, which started at age 62 after my wife died on active duty Navy. I turned 65 this month, so Medicare has kicked in. Should I wait until age 70 to take my own Social Security?
So spousal death benefits, I believe you're probably talking about the primary insurance, the survivor benefit, not something related to what the military pays out. But if you're talking about the survivor benefit, there is a unique feature. And the survivor benefit, it nudges. And it nudges in a positive way. Now, I'll tell you exactly what I'm talking about. If you look at all of the things that have happened to Social Security with these different amendments, they've nudged. They've nudged down. And they've nudged down for the Social Security recipient from age 65 to 67 in terms of full retirement age over the course of 20 years. They've nudged up the amount that Social Security, the FICA payment is for Social Security. This is a rare instance where the survivor benefit actually nudges in the recipient's favor. So one of the things that it nudges is you have a choice. You have a choice between your own primary insurance amount or the survivor benefit. And so you can pick, and there's no haircut. We talked about a few minutes ago, we talked about the concept of dual entitlement. If you file for your own benefits early and then later when your partner files for his or her own Social Security benefit and you take the larger spousal benefit, there's a bit of a haircut because you filed the first benefit early. It doesn't work that way with the survivor benefit. It nudges in a positive way. So they actually do give you the option. Now, what that means realistically is that you can choose. I will tell you that the big difference, though, is that the survivor benefit is a sum of two calculations. It is a sum of the base that your deceased partner was receiving or would have received if they had reached full retirement age and hadn't filed yet, or if they were over full retirement age, what they would have received at their time of passing. So it's, again, they're nudging up. They're giving you the benefit of the doubt, and they're saying that, okay, if they passed away before full retirement age, we'll make the base full retirement age. If they passed away over full retirement age, we'll make the base what they would have received at full retirement age at the time of passing if they haven't filed. But there's also a taketh away. So that's the giveth. The taketh away is the age that the survivor files for the survivor benefit. And if you file under your full retirement age, well, there's a haircut. And so, but there isn't a benefit to filing after full retirement age. You're going to cap out at 100% of that base amount. So if you let your own Social Security payment grow all the way up to age 70, you can get in, if your full retirement age is age 67, you can get up to 124%. So the comparison is really what is your own benefit if you wanted to let it grow up to age 70, you pick the year compared to the survivor benefit and when you would file for the survivor benefit.
Okay, great. Next question is from Paul. I understand you can suspend benefits at 67 and get a larger amount by starting again at 70.
Yep.
Is this only possible if you file at full retirement age?
No, so this is a little known provision in Social Security, and that is you can file for Social Security early. You can file at age 62. And then once you reach full retirement age, you can suspend it and then let that grow. and let's just say your full retirement age is age 67, then you actually could let your Social Security payment grow from 67 to 70 and get 8% per year on your base. Now, here's the caveat to that, and just using the numbers that we talked about a minute ago for a moment. If you file for Social Security at age 62, you receive 70% of your full retirement age benefit. If you then suspend it at age 67 to let it grow, and people do this, you're going to pick up 8% per year, but it's on 70%. It's not on the 100% that you would have received while you waited. So it's 108% times 70%, 116% times 70%, 124% times 70%. So the mistake most people make is that they think that if they let it grow from 67 to 70, they're going to end up with 124%. You end up with 124% of 70% if you filed at age 62.
Okay, so D. Comed asks, my spouse passed away 2 years ago. I have been collecting my Social Security. My question is, will I still be able to receive their Social Security when they would have turned 67? Will it be the full amount or 50%?
Okay, so the spousal benefit, going back to the original question we asked, the spousal benefit's 50%. You can't get any more than 50% of your partner's full retirement age benefit. The survivor benefit is distinct from that, even though it is a benefit that the spouse, the survivor, receives based on the earning, or based on the amount that the primary insured, the deceased, was receiving. It's not the same thing. So you can receive up to 100% of what they were receiving, or they would have received, had they not filed, and actually more than that in a very rare circumstance called the widow's limit. Very complicated, but if you're interested, I'll put a video link in this live stream at the end on how the widow's limit works. But basically, the spousal benefit and the survivor benefit, they both start with an S. They both are a benefit based on your partner, but they aren't related outside of that. And so the answer is you can actually get, in many cases, a much higher benefit from the survivor benefit.
Okay, great. And, just to add in that, I know a lot of people that I interviewed from the beta test talked about there is great detail covered about spousal benefit and survivor benefit in the Social Security Simplified course. That was one area that people were really talking about that they really enjoyed. Okay, so next question comes from Angelo Loro. My wife filed at age 62 and I will file at age 67. We are both 65 now. Will my spouse get 50% of my Social Security since 50% of mine is higher than hers?
So this goes back to a video I'm going to be putting out. It sounds like I got to get it out on Thursday now. Check me on Thursday for this, but probably slightly less than 50%. I don't know your specific circumstances, but usually if you file for your own benefit and then you switch to the spousal benefit, that means that the spousal benefit by definition would be higher than your own. And so if your spouse filed early and you filed later, then the clock started ticking on a piece of that payment when your spouse filed, and the numbers depends on the size of your payment. It depends on the size of their own Social Security payment. It depends on the size of the spousal benefit, but there's probably some form of a haircut, and I'll give some examples in this video when I put it out, just so you know.
Okay, Cheryl Klebert is asking, can you discuss being single And should we retire at 62? How much do you think is a safe number in 401k to retire and start Social Security?
That's I personally know people that retired and live only on Social Security, and they live a very Spartan lifestyle, but they're very happy. And for them, it's about life experiences. I have something called the S curve on my website. So if you want to check it out, go to hollyschmidt.com and look up the term S curve. S stands for Schmidt, by the way. I don't think anybody else has done the S curve out there, but basically it shows effectively a swooping line, and on the left side of the S curve are the basic things that people need, and on the right side of the S curve is the rock and roll Mick Jagger type that has so much money they don't know what to do with it, and what they spend their money on. And so you're talking about a nice Japanese car versus a Learjet, for example, in terms of what they spend their money on. But what the point of the S curve is that the spending, you can go crazy. I mean, if you have that much money, you can go crazy. But the happiness level when you go crazy isn't that much different than the happiness level if you have the right base. And that what I mean by the right base is, are you living in a safe neighborhood? Do you have the proper medical care? Do you have the proper nutrition? And if you have the basics covered, then the rest is nice, but it's not this. It's more like this. So the growth is not that much more. So I don't know how much you have in your retirement savings. I don't know what your Social Security benefit is. I don't even know what your expenses are. But I will tell you that people do it both ways. And really the best thing to do is to either get a personal financial planning software of some sort, or talk to a financial planner, because that's really the only way that you can do it, unless you want to just model it out yourself. And there are a lot of great Excel programs you can just download from the internet for free on budgeting. In fact, if you go onto my website, there's a basic one on there as well. Just look up budget, and there's a download that you can have for free, and it's an Excel download. It's great. It'll help you with this.
Okay, Fast Eddie is
God,
asking.
I love that name.
My wife is divorced from her first marriage for 9.5 years. Can her ex-husband collect on her Social Security?
9.5 years. Geez, you would want to advise somebody in this. The minimum you need to be married to collect divorce spouse benefits is 10 years. And so if it's less than 10 years, they wouldn't be able to collect on the divorce spouse benefits. And what's really interesting about divorce spouse benefits and spousal benefits in general is that as a family unit, let's just say that I claim Social Security and my partner claims Social Security and my kids were young enough to claim Social Security. There's a limit that you can actually claim. It's somewhere between 150%, I think it's 182%, 187%. And so when you go beyond that amount, you actually are in a position where people's payments are actually reduced. There's only one exception to this, and that's the divorced ex-spouse benefit. And I use a description in this course that we're talking about where somebody can have an ex-spouse that they were married to for 12 years, another ex-spouse that they were married to for 12 years, another ex-spouse that they were married to for 12 years, and have their current spouse, and all of them could collect a spousal benefit because there is no limit. There isn't that 150% limit. So and people get very territorial about this. I don't want my ex-spouse to get a Social Security payment because, well, you fill in the blank. I've heard of a lot of reasons, but it doesn't affect the size of the family maximum. So 9.5 years is a bit short.
Okay. John asks, so this one you might need some paper for. It's got many parts. Okay, so here's the information background on it.
Lay it on me.
It's an older spouse worked and collects the reduced Social Security before full retirement age. Example, $500 per month. Okay, the younger spouse is waiting till full retirement age to collect. For example, $3,000 per month. The older spouse has now passed full retirement age when the younger spouse starts to collect Social Security at full retirement age.
Yep.
Okay. Half of the younger spouse benefit is $1,500 per month. The question is, does the older spouse get 50% of the younger spouse's benefit?
Probably not. But also, it's probably not going to be that much less either because the difference is so large. Remember how I said at the beginning, under dual entitlement, you have, when you file for Social Security and you're entitled to not only your own benefit, but a spousal benefit, there's a spousal top-up, effectively, that you receive when your partner actually files for his or her own primary insurance amount, because the spousal benefit can't be paid out until the primary insured actually receives the primary insured files for their Social Security payment. If the older spouse who is receiving $500, that's 1/3 of that $1,500, filed early, and let's just say that they filed and they got 70% of that, so that's $350. That's $150 less than they would have received at their own full retirement age. But the big payment, which was the spousal benefit, doesn't come into play until the older spouse is well over their own full retirement age. And so in that instance, there'd be a bit of a haircut, but it's not going to be that much.
Yeah, and so the part two, and you might have just answered that, is will the older spouse benefit percentage be permanently reduced since initially collecting prior to full retirement age?
Again, all caveats on this because I don't know the specifics of the situation, the ages of the people. Probably a little bit. I would say probably a little bit based on what I'm saying here, what the way that this was described, but it doesn't sound like it's going to be a huge haircut.
Okay. Paul is asking, what is the penalty of earning income when taking Social Security?
So the penalty so you can earn up to, if this is not your full retirement age year, the year that you reach full retirement age, you can earn $23,400 and not have any penalty. Anything above that, you have to give $1 back for every $2 over that amount. In the first year that you file, again, assuming that this isn't your full retirement age year, it's broken down to a monthly test of $19.50 per month. And the reason it's done that way, by the way, is let's just say you're a huge earner. Let's just say you make $100,000 a year, and you file in September, and the SSA says, okay, well, this year you already earned $100,000. You owe us half of, what's it, 23,400 minus 100,000 divided by 2. You owe us half of like $76,000, $76,600, $75,600. So you owe us more than we gave you. It would make no sense. So what they do is in the year that you reach full retirement age, after you start receiving your Social Security payment, you get that's when the clock starts ticking. In the calendar year only that you file for Social Security, it's a monthly test. Anything above 1950, you give back $1 for every 2. Now, just to close out the thought here, you don't give it back and it's not permanent. It goes back into your account, so to speak. And when you reach full retirement age, it comes back to you in the form of a higher Social Security payment. Also, in this instance, if you know that you're going to be just blowing this number away, you can also tell the SSA to withhold part or all of your Social Security payments so that you aren't in a position where you have to pay it back. The worst thing that can happen is that you think that you have all this money only to find out that you get a bill for $25,000 as you're looking out into the driveway and you see your new car out there, realizing you might have been able to keep the old car for a few years longer.
Okay, Steely Dan asks, will this live stream content be available on your channel? He has been a subscriber since you began.
Nice. Well, I'm glad, Steely, I'm glad that you've been with me the entire way since 2020. Yes, this will be on the channel, and it will be available for anybody to watch basically for the foreseeable future. I can't see a reason it would ever come down. So if you want to watch it again, just come back and look under live stream.
Okay, great. So Bill Everlane asks, my credit union takes money out of my Social Security check every month without asking. Is this legal?
So if it's happening, it's probably legal. And if it's happening, it's probably the following. Tell me if I'm wrong. Actually, you can't tell me if I'm wrong. Sorry, but let me guess at it. And that is, if you aren't telling them to do it, and they're doing it anyway, there may be a lien of some sort on your Social Security check. And if it's coming from a credit union, so the government can actually put a lien on your Social Security payment under certain rare circumstances, and it is rare. But if there's a financial claim against you, particularly if it's from a government debt, and in this case, I'm talking about a student loan debt, then the government can put a lien on your Social Security payment, and they can basically take part of your Social Security payment. That might be what you're talking about here. It isn't. It would be unlikely that they just start randomly taking money from your Social Security payment. Now, if they're taking it from your checking account, not your check itself, but actually the check gets deposited into your credit union account, and it's now just free cash, that might be something else. But specifically, a portion of your Social Security payment before it goes into your account, it's probably a government debt of some sort that you're behind on.
Okay, Beatrice asks, does the cost of living adjustment really calculate inflation correctly? My husband and I are having a debate on this point. I say yes, and he says no.
Sort of. So this is the subject of many those emails that you get, conspiracy theory emails that you get talking about the cost of living adjustment and how it doesn't reflect inflation. There's some truth to this, but let me explain this in its entirety. There's something called shadow statistics, shadowstats.com. I believe that's the name of the website. And they track what your what your COLA adjustment should be if there weren't several adjustments to it. Well, what are the adjustments? There's what's called a substitution adjustment, meaning if you were to go out and go to a restaurant and they had, for you meat eaters out there, the example I like to use is they have steak on the menu, and you like the filet mignon, but you look at it and say, geez, that's $45, but the New York strip is $30. Well, the cost of living adjustment, which is based entirely on the Consumer Price Index, CPI-W, would say you have substituted filet mignon for New York strip. Therefore, your spending has actually gone down. So you are better off now because your prices have gone down. Well, yes, but you made the choice consciously because it was too expensive to buy the steak. And so there are a lot of these types of adjustments in the consumer price index. And CPI, the cost of living adjustment, is based on CPI. It is CPI. You have to do a couple of things. You have to average the third quarter and divide third quarter this year versus third quarter last year. But it's basically CPI. Shadow Stats takes that and they say, well, no, what's actually happened to filet mignon? Let's actually look at that. And so you see almost always a bigger number. And on the flip side, if you buy a car and you don't want to buy the manual window, I don't even think they sell them anymore, but when they first started selling cars, you had the option to buy a car that had a manual crank on it, and you pay $500 less for the car. Well, Shadow Stats says, well, you gotta, now you've got this, all these add-ons, and so therefore you have to take that into consideration. And the CPI is saying yes, but if you were to take those off and the car really did have a manual crank, it would be $500 less. So there are some adjustments that are made. Are they all rational? You could argue no. Is it about right? It's probably the way people spend money. And so, yes, I would say if you're looking at how a human being spends money today versus last year, the cost of living adjustment probably reflects that. The only thing I will say, just to close this out, is that CPI-W, which is the base for the COLA adjustment, really reflects a certain segment of the population, basically hourly wage earners and clerical staff. And that's 25 to 30% of the population, which means it doesn't reflect what the balance of the population is spending their money on. And it certainly doesn't reflect what someone in retirement spends their money on, because there's a lot more expensive medical expenses, for example. There's also one called CPI-E, and that's a better reflection. Will they make the adjustment from CPI-W to CPI-E? I don't know. If you took 20 years of history between the two, you would see that they're pretty similar over a long period of time. Year over year, they're actually pretty wild swings. So the long answer is it's probably right, but know why it's right, and that is because it's based on how people spend their money, not based on what's happened just wholesale on prices.
Okay, next question is from Jose Alejandrino. My spouse is 3 years older than me and did not work. I, as main income earner, will claim at 70 years old. When can my spouse claim spousal benefits? 73 years old?
Yeah, that is correct. So this is the one thing I would say I have a disagreement. Disagreement is too strong a word. It is an obvious area of improvement for Social Security, and that is oftentimes you have people with a big age gap, particularly second marriages. And in the second marriage, in fact, on the course Social Security Simplified, we had a team of people that were doing the testing on this, and they had age differences both ways. We had one couple that had a 12-year age difference where the big earner was younger, 12 years younger. And we had another couple where the big earner was 17 years older. It works better for the spouse if the big wage earner is 17 years older, because then the benefits available basically when the spouse gets around to it. It's a problem when the spouse is older, because you got to wait until the primary insured files for his or her own Social Security. So unfortunately, the answer is yes. You have to wait until to the primary insured files for his or her own Social Security benefit if they're married. If they're divorced, that's a different story. then there's a 2-year waiting period before they're officially decoupled, but that's not what we're talking about here.
Okay, DB Douglas asks, never been married. If I do marry, will my spouse get my Social Security benefit automatically, or do we have to have been married for more than how many years?
12 months. 12 months, unless there are some exceptions if you have a child together. But this, in this scenario, I believe you're talking about how long does my spouse have to wait after we get married to be eligible for spousal benefits, and the answer is 12 months.
Okay, we are rounding the end. We have time for just a few more questions. We have 5 more minutes. Daniel asks, if I retire at age 65 and also earn $23,000 per year, will 401k withdrawals count as earned income?
No. So the earnings limit is based on earnings from work or earnings from self-employment, not from withdrawals from your 401k. And so, in fact, if that was actually true, there'd be a lot of people in trouble, because a lot of people, they usually roll their 401k to an IRA, not always, but oftentimes. And if you start drawing that down to live a lifestyle, a lot of people spend more than $23,400 in retirement. So no. And if you take out a loan against it and you repay the loan, no. If you don't repay the loan, and then they credit or they eventually take it from your 401k, well, the answer is no. It isn't earned income, and it isn't income from self-employment.
You just answered a question for D. Comed, and he asked if you could put the link to the video you mentioned.
Yeah, sure. No, if the links that we mentioned, the videos we mentioned here tonight, if you come back to this live stream tomorrow, actually give me until Thursday, because I need to go back through it and figure out what I promised. If you come back here Thursday, you'll find the links to everything, all the videos that we recorded on these points. I know that I recorded them. I know approximately when I recorded them, but I won't be able to get to them ASAP. So if you give me 48 hours, come back here and you'll find the links to everything I promised you would be they'll be in the description.
Okay, Barbara is asking, I am 63 and will retire as a public school teacher in California December 31st, 2026. I'll be 64. I also qualify for Social Security, and at 67 will take that. But can I take it sooner without penalty?
No. So Social Security is, you can get more payments, but they're smaller, or you can get fewer payments, but they're larger. And you have a span from age 62 to basically age 70, and the closer you get to age 70, the larger the payment. But every year that you wait is 1 year off the back end, assuming that things don't change, and assuming that the expiration date, so to speak, it doesn't change. And I think that's a pretty safe assumption, unless somehow early Social Security changes your health. But we can't. Nobody would really know that. Let's just assume, for the conversation's sake, that it doesn't. Then the Social Security Administration will give you more payments, but smaller if you start early, or larger payments, but fewer if you wait.
Okay, and Mark, thank you for letting us know. We skipped a few. The chat box sometimes moves very quickly, so I'm coming back up. Jeff Harmon had asked, married pair, primary files at age 62, spouse files at full retirement age. Primary dies first, hypothetically. Does the surviving spouse step up to primary at 62 or primary at full?
Can you repeat that?
Yes. So this is a married pair. The primary files at age 62, so early.
Okay.
Spouse files at full retirement age. The primary, who filed early, dies first. This is hypothetically speaking. Does the surviving spouse step up to primary at 62 or primary at full retirement age?
The base is the base. The payment is based on the amount that the primary insured was receiving if they were actually taking Social Security, adjusted for the age of the survivor. So if the survivor files early, then that base is reduced. At age 62, just using 2025 data, 2026 data, that means that the primary insured would have been getting 70% of their own full retirement age benefit. If the spouse files for the survivor benefit at age 67, their own full retirement age, the base is 70% times 100%. Now there is a provision, and remember what I told you about the survivor benefit nudging up, called the widow's limit. And actually, under certain circumstances, if the spouse waits until, I believe it's 62 years and 9 months, then that's going to max out the payment. Now, there's a lot around the widow's limit, and this was the one that actually I think I was going to put in the description as well. I have a video on this. The widow's limit is not a slam dunk. It is an exception because of this very specific situation, but there's a way to get to 82.5% if the survivor waits a bit of time before filing for the survivor benefit.
Okay, we are at 8:02, so thank you all so much for sticking with us a little bit past the time. And we did get through many of your questions. There still are some more, and we will be taking those in and putting them on for next week. So, so thank you so much for all being here. And Geoff, you want to wrap us up?
Gang, thank you so much. Jill, thank you for being my co-pilot here again tonight, and I will see you again next week. Don't forget about Social Security Simplified, getting the most from your Social Security payment, 50% off, early adopter discount through the end of August. And thank you for spending time with me this evening. I know we kind of pushed into your dinner time. Sorry about that, but this seems to be, we ran a poll a long time ago, and this seems to be the time that works for most people, or more people than other options. So with that, why don't we call it a night? Thanks, gang, and I will see you 1 week from tonight at the same time. Take care, everybody. That's it.